John has a bear put debit spread, different than sort of the bull calls we were looking at earlier in the bull puts. We're doing a reverse now here. We're doing a bear put debit spread. Okay, and this is actually is a bear's position. We reviewed that bull call debit spread on Tesla, the at the money or out of the money that we might use with the bull call spread that's further out in time. John's doing this in a bear put debit spread. And the underlying kept coming up almost to the lower strike price of my sold put spread, threatening my sold put strike. What do I do? Okay, John. So now that we've sort of seen what a bear put debit spread is, usually what we're going to do is sell. If we're doing shorter term, as we talked about, we might be selling a slightly in the money put here and buying a higher strike put at a debit. As long as the stock stays below both strike prices, I'm forced to buy shares of stock here, let's say at 55, but I have the right to buy shares of stock at 60. So my debit might have been $3. I get $5 back, and I have a profit of $2 on this position. Okay, good. Now let's take a, again, fictional example. I'm gonna use some numbers here, John. I'm gonna use some real numbers here. And I'm going to use Ally again just because I'm familiar with it. You saw where it was today at about 54, but it was down to about 53 or so, I believe, a couple weeks ago. Maybe even less than a week ago. Let's go take a look. So I'm going to go to the chain for Ally, and I'm going to use some of our historical features. Now, this is a trial account, so I have access to about 3 months of historical data here. On the historical subscription, you actually have about 9 years of historical data. And I'm going to go back to the 20th, I think. I'm going to go back just about 8 days here. I just want to see where this stock was. I could also just look at a stock chart, but I want the options prices as well. Okay, so 1 day left to expiration. The stock's at 52.72. Perfect. The stock does not offer weekly options. I probably should have used one, John, that did, but we're going to use the June series. So for my put debit spread, when the stock was at 52.20, 52.72, let's just go to June. In any case, I could have sold the June 55 out of the money put for midpoint, let's just call it 365. At the same time, I would have bought the 60 for about 733. This is not a great return, but that's okay. We're looking at about 370 for a 5 points, but that's pretty good. Now, the probability here is lower than I normally would have done. It's about 34%, but we're just going to use these numbers, John. Yeah, and he said when I sold both legs, both were already in the money. And that's what we're doing here. It's not as deep, I know. The stock's at 52. We're going to be selling the 55 put and buying the 60. Both are in the money in that case, okay? Above the current stock price, that's where we're in the money for this position. If we had opened this on May 20th, when the stock was at 52.72. All right, so ALLY, June, 55.60. We are going to sell that position. I said 365 for our 55 strike put. We're buying our higher strike put at 733. So we're going to pay a debit of, what did I say, 270? I'm sorry, 370, roughly about 368, 370. For a max return of 132 if the stock remained below both strike prices on the position. Now the stock's at 54.71. I saw it at 54.95 today. It might have actually broken 55. I chose this because I know this stock and because we see here a similar situation to what you described. We would have opened this position 7 days ago when the stock was down here at 52 and probably waffling around 51.50, 52.70. And then we had the movement pushed up today and in the last couple days, so we're right near our short put strike price. Now, John, a popular presentation that we have on YouTube and we have on Power Options in our webinar archive there, we might take a look at that in just a moment, are the 8 ways to manage a bull put credit spread. There's also a webinar on 8 ways to manage a bear call credit spread. For the debit spreads, there's only 7 ways. We lose away in the debit spread to manage a position in relation to credit spreads. But they're all pretty much similar in the sense of what we can do. So First things first, yours is a little bit different. You said the lower strike was coming up to the put spread, threatening your sold put strike. What do I do? Normally, let's go back. Same exit trigger and discussion I would have on my credit spread conversations as I would in a debit spread. Rules of thumb for the trigger points, John, and you're close to it, is threatening your short put strike price. When I decide when to exit or when to roll or when to adjust, one of three things or a combination of three things is happening. One, the stock was within 1% of my short put strike price. Credit or debit spread, that's my pivot point. Okay, that's where I'm concerned about. We sold the 55. Okay, and this is at exactly a little bit more than my 1% rule. My warning sign would have been at 54.50, and we're there today. So in the 50 cents, 1% of the short put strike price, we're there. All right, so we're at the 1% rule. Two, as we discussed earlier, John, you saw some of the settings I had for the bull put credit spread screens. We were looking for the positive MACD, at least above 3 days in that case, and I was looking for stocks that were above SMA 20, usually for the bull put credit spreads if they're 14 days out. If I was 35, 40 days out, I'd be using SMA 50. So the technical indicators you use, whether you use stochastics, John, whether you use some other variation, maybe use Fibonacci, if the technical criteria that you use to get into the position have reversed, so your stock technicals or fundamentals are reversing, my stock is now originally, when I opened this position, maybe the stock was below the 20-day moving averages. And now suddenly, Ally's above the 20-day moving average. I had opened this bear put when the MACD was negative. Now the MACD is positive. So that's an indication of, yes, those two things are happening, or one or two of those things are happening, and I'm in the 1% rule. I've got to consider something. All right, John, so what do we do? First, these are going to be out of order because I always forget the order. Someone, I think it was Kip or Sam, gave me a great suggestion a month or so ago and said you should just have a note card on your side with your 8 ways for credit and debit spreads so you can just go through it. And they're right, but I haven't done that yet. Number one, of course, is do nothing. If I'm in this bear put debit spread on Ally Financial, still with 21 days to go to expiration, to June expiration, and now it's hit my trigger for potential roll or potential adjustment on this trade. What I want to look at first, John, what happened? What was the cause of this? We just saw the financial sector were moving up. When we looked at the industry and sector movements, we saw that moving up as well. Is this a one-day thing, or is it pointing to a higher side that the financials might continue to be pushing up? What caused that sector or industry increase? Was it good earnings from another bank? Was it positive numbers on employment that came out recently? Something along those lines. Something maybe about interest rates that came out recently. Today or in the last 24 hours. I'm not sure, but I want to check that. Is do nothing worth it? Well, do nothing means that an event happened to your stock or in the sector that pushed everything up, but you think it's going to come back down to normal. You think it's going to ease off and go back down to the ranges. In other words, if I chose do nothing, it's because what I saw that caused this to happen is a one-time thing. It's not a sign of the consistency of growth. But the stocks have been moving up, melting up, as we should say. So that's one. Number two, close. Okay, so just close the position. I've hit my triggers. Everything technical is going against me. Is it worth it to stay in it longer and take a higher loss than what I have now? We'll actually look at that in a moment. But again, it might not be what I want to do. Okay, but I may just want to close the position to avoid taking further losses if I wake up on Monday. Well, it's too late now for me anyway, but if I wake up on Monday and Ally's suddenly trading at 55.80, 56, 56.20, I'm going to be at a much higher loss than I am right now. So maybe it's okay to close it, just take the loss and move on. 3, normally when analyzing a credit spread, let's say, John, that this was a bear call credit spread where I'd sold the 55 call and bought the 60, and now it's being threatened. If the stock, if everything I'm seeing now technically and fundamentally shows me that the stock's going to continue to move up, an advantage that I have with the credit spreads that we don't have with the debit spreads might be just to buy to close the short option. It's going to cost me a pretty penny. It's going to cost me a lot more than the net credit I might have received, again, if this was a bear call credit. But again, if my anticipation is the stock's going to continue to go up to 57 or 58 in the next 21 days, the increase in the 60 call by itself, just a long call position, might counter the buyback cost that I've had to take on this position. Unfortunately, in a debit spread, that doesn't work, because if the stock continues to move up, your long put's going to lose more value. So that's the one that's missing. That's why there's 8 for one and only 7 for the other. So the question begs, can I just sell to close the long call now, leave the short put open, and have a naked put position? You could, but again, do you really want to put up the capital? You were trading a debit spread or a credit spread on purpose to use leverage. You want to be in a naked put now, or a cash secured put where you have to put up the money to potentially buy it? Probably not. Okay, so what is number 3 then? Close and roll. Common approach, not necessarily the best approach in the position, but number 3, you can close the entire position and roll it. I'm going to erase these real quick, and we're just going to write them back in so we can see things better. So 1 is DN, do nothing. You think the stock's going to recover? Not recover. You think the stock's going to pull back down, John. 2, close and get out. Don't overthink of it. Take the loss you have on the position now and move on. 3, close and roll, or we could just call it rolling. So what am I doing here? I was originally expecting a return of $132 off an investment of $368, $370. I'm at a losing point right now because the stock's here and we still have 21 days to go, and I could potentially enter into higher loss ranges. We're sort of in this range here with the red line, and we can enter into higher loss ranges on this position. So I might be able to liquidate this position and take a loss right now, and then look for a bear put debit spread on this stock going higher. So close and roll. Okay, keeping the same structure, but going out. Maybe now I'm doing a 60 and a 65 spread, but I'm probably going out to July. I may be going out to September. Why? Because I expected a return of 138. I paid 368. So right now, if I liquidate this, I might be at a loss of, let's say, $1.10. Okay, so I'm realizing that loss. If I roll out to July, that 60 to 65 might be giving me a net credit of $1.32. or a max return of $1.32, which would cover this and then be only a 20-cent profit total for trying to manage the ally position, John. If the net debit for that 5-point spread is 410, meaning I can only get 90 cents back max profit for the new July spread, that still puts me at a loss on the total trade. I may need to go out to September to make up this $1.10 plus still a reasonable profit on the position. The one thing that I don't like about doing this approach, whether it's a credit or debit spread, the stock moves against me. I've got to close the position, and I'm analyzing just rolling it up to higher strikes in the case of this bear put debit spread, or rolling it to lower strikes in the case of a bull call debit spread, to try to keep a probability as the stock's moving against me. We have to almost analyze this as a whole new position. Any of these potential adjustments we're talking about, you're really looking at as a whole new position. Meaning not necessarily taking into account what is the loss you have now, but also what is this stock doing? What are the current conditions of this stock now? If you looked at it fresh, without the idea of potentially managing the position, trying to make sure you get a profit on this one stock position, this ABC, XYZ, ALLY position, whatever it is, rolling up to a bear put debit spread when all the fundamentals and technicals are going in a bullish trend might be setting you up for more losses in the future if it continues up, no matter how far out of the money you go. And that brings us to maybe number 4. Close and do the opposite. Instead of just rolling and keeping the bear put debit spread on a stock that's moving up, I might close this bear put debit spread now, take my loss, and then look for maybe it's a little risky, but maybe a 55-50 bull call debit spread out to July, out to September, because the stock is now moving in a bearish fashion. Of course, both of these have the same problems. I close and just roll to a new bear put debit spread at higher strikes, and the stock continues up, I'm going to have larger losses. If I close and do the opposite, the bull call, and I find one that covers this initial loss I have plus gives me a new premium, But now the stock reverses and drops back down to 52 and 51. Now I'm losing on that further out bull call. Each management technique does come with its pros and cons in this situation. And John, of course, I'm going to do the same thing I had mentioned to Jackson. I'm going to point you to some videos later on this weekend, or maybe after the webinar later tonight, on ideas on managing debit spreads, where it sort of outlines this and maybe the pros and cons a little bit more than we can get into today. Number 5, I'm not sure if this is the one I would prefer to use. We closed opposite. I wouldn't say you could create a butterfly or a condor in this position. Now with debit spreads, it's a little bit trickier. So you can create a butterfly or a condor to act as a repair. And what's the difference? You could maybe now sell. I'm just going to put that in. 5 is create condor or butterfly, okay? And you could sell maybe a 55 call and buy a 50, which would do the bull call debit spread on the downside of this position. It would cost more money, which was going to increase the risk, but your upper and lower break-evens would increase in that situation. And the condor, of course, that's the butterfly. The condor, of course, on a debit spread, you might sell a 50 call and buy the 45, so you have more of that table profit and loss chart. The risk won't increase as much. The profit won't increase as much, meaning the upper and lower break-evens. We're going to take a look at those manually in just a minute. So create condor or butterfly. Now, of course, the one I mentioned, but I didn't really put in here is you could just buy to close the short and leave it as a naked put, but I don't think that's what you want to do. So that would be number 3, and then this would really be 4, this would be 5, and then create the condor would be 6. Create condor or butterfly, I'll lump them in together. Of course, number 7. It's what's called the pendulum adjustment. And in this case, it's probably not the opportune time to do it. The pendulum adjustment usually works best when the stock moves, debit or credit. It works best when the stock moves up above and between the two strike prices. Now, in number 4, we talked about closing and doing the opposite, where you'd close your June spread here for a loss and you'd look for a July bull call debit spread, because that's where the stock is trending to make back the profit on the position. But if it's between the strike prices, there's sometimes an opportunity where you can simply sell to close the long option, the 60 put, and buy to open a 50. You're just rolling the one option for June expiration, and in one move, a swing of the pendulum in a sense, you've just converted your bear put debit spread that's at a loss potentially into a bull put credit spread on a stock that's trending up. I wouldn't do this when it's right at the money. I usually wait for it to go up between the strike prices. I don't wait for it, John, but when there's that sudden event that happens where the stock's been flirting with my short put strike price in a debit spread or my bull put, and then the next day it just sort of breaks down and it breaks between the two strike prices, that's when I'd use the pendulum adjustment. Okay, so we could convert it to the naked put as the one that's sort of missing. That's why there's not a 6 there. But again, we decided not to do that because your objective was usually to stay in margin and not have the full margin requirement or cash secured requirement of just closing this long put now and leaving the naked put open, and it might not even be profitable. Okay, so that's sort of the review. Do nothing, close the position, close and roll, close and do the opposite, create a condor or butterfly, or the pendulum. Let's take a look at some of those very quickly because we are at 5:56 p.m. I do want to encourage anyone, if you have any last minute questions, to go ahead and send those in. We can try to get those covered, but we're going to spend a few minutes now with John talking about some of these examples so we can see what would happen. First things first, in the ally position, we know we paid a debit of 368. So what I'm going to do here is simulate what this position is going to look like if I do liquidate it right now. Just going to give me a raw number. I could put it in the portfolio and see exactly what it is. But I'm just going to simulate doing the exact opposite. We're going to buy to close the 55 put, sell to close the 60 put. Ooh, it's going to be a debit of about $4 almost, $3.90. So it's not too bad. The loss here is only $22 in this case. I'm actually making a profit. We paid a debit of $368. We're getting $5.52 back for the 60. It's only costing us $1.63. Okay, so this is actually closing at a profit. That's pretty good. You're not there. I understand that, John. You're not there. Let's assume Let's assume the opposite. Let's assume this is a loss of $44. Why is that important? Okay, so we know we have a loss of, let's say, $44, and maybe a little bit more if we liquidate right now. I'm sorry, my example wasn't that great, and it can actually be closed for a profit. That's sort of okay, too. If I'm in this situation, John, I know you're not, but 54.71, 1% roll. The technicals are going against me. I could liquidate this bull put now and make a $22 profit on this position, even though I was hoping for 132. Yeah, I'm going to take that small gain, move on. Right. Now, the more complex ones, of course. First things first, let's talk about managing this position as is. We're going to stay in June. The harder ones, the more complicated ones. What if I did the butterfly? Sell the 55 call and buy the 50. This is going to create a debit butterfly for you, all debit, so you don't have to put up any margin requirement. And you see here, it increased the monetary return on the position up to 275. If and only if the stock's trading right at 55 at June expiration. Very slim chance of that happening. It could, but it's going to be waffling around a much. But what did you do? You increased your break even up to 57.76 to the upside. So that gives you a wider break even, and you did create a lower break even, but it's about 2.5 points below where you are right now, where the stock was when I initially entered this trade. Not that that means anything. The risk goes up higher, though. The monetary cost goes up higher, but the maximum risk is still only 224.50, because if one's losing, okay, if the stock does fall back down to 50, where the bear put spread would have been a perfect profit, you're losing on the bull call side, but you are profiting on this. The max loss is only 224. One of those is going to be at full profit. Well, I should say if one of these is at full loss, one of them's at full profit. So that's kind of the hedge you get there in that situation. Now you're getting 5 points back is what I'm trying to say. To hedge, that cost is 724, down only 224. The Condor repair would be similar, but you're going to be paying a higher debit because you're going to be deeper in the money. So that was an at-the-money 55 call with the 50 put, John. Doing an in-the-money bull call, and we'll keep the same 5-point difference, even though they offer 1-point increments. But we'll sell the 50 call, buy the 45. And what does that give us? Well, that gives us the plateau, the table profit and loss chart. Lower potential return. Upper break even's only now at 56.50 instead of 57. So it's not as high as an upper break even, but it's still a good window to that new upper break even price. Whereas the break even before on the other one was the 370 minus the 60 strikes. So that would have been 56.30. Yeah, 56.30, excuse me. So this didn't increase it by too much, I'm sorry. So it would have gone from 56.30 on your initial debit spread now up to 56.50, just a little bit more wiggle room in that case. But if the stock pulls back, you're still making 149, but now your cost doubles. Instead of the 368 we had, more than doubles. Instead of the 370 we had, excuse me, debit into your initial bear put, John. We're now looking at a debit of 850 because the higher cost of this deeper in the money bull call spread in this case, to add to that factor. Now, let's go back to square one. And again, this usually doesn't work in this case, but I'm going to take a look at it for you. We're going to talk about the pendulum. These are the more complex ones in this scenario. So again, the pendulum, what am I going to do? The stock's moving against me. I think it's going to go bullish. I decided not to do, let's say, the Condor or the butterfly debit repair, turning it into a butterfly or turning it into a Condor. So, and I don't want to just close this one and try to look for a July bull put because maybe I'm uncertain on the markets, or I'm sorry, July bull call, doing the opposite because I'm uncertain. If there's a chance that the sell price of this long option here and the buy price of this put here is greater than the initial net debit, then I may be able to perform the pendulum adjustment, where again, what are we going to do? I'm selling the 60 and buying the 50. I'm not touching the 55. And so what we do here, we create a bull put credit spread on a stock that's moving up by just simply swinging our option, the pendulum adjustment. Does it always work? Usually it works when it's between the strike prices, not right at, but let's go ahead. Sell our 60 put, buy the 50. It did. So what we have here now is a bull put credit spread where you've got to put up the margin requirement. I'm sorry, the margin requirement was just 5 points. It's showing 10, and I'm not sure why, but it'd just be 5 points here because you've sold the 55 and you've bought a 50. So you have to put up $500, but this still works out to a net credit of 165. And your break even is now to the downside at 53.35. This would work, major caution though, if and only if Ally continues to move up to 55, 55, 50, 56 in the next 21 days. If it pulls back down to 52, we're at a loss with a bear put debit. This is what I meant by you're almost reevaluating the entire position from scratch. I know we're looking at Ally here, but take a look at your stock position. Just looking at it right now, if you were opening any new position based on how you look at a stock chart, fundamentals, and technicals, what would you consider doing? A neutral, a bullish, or a bearish strategy? Ignore completely why you entered the position to begin with. Ignore completely where your position is. Look at the stock brand new with a mind that you don't have a position open and say, what am I looking at on this chart? Is this stock what I would open for something for bullish or bearish or neutral? And that will help you dictate, do you want to close and do the opposite? Do you want to evaluate a pendulum adjustment if you're still bullish? If you're neutral, evaluate the condor or the butterfly. If you're still looking at that chart, you still think it's bearish, even with this small last 3 or 4 day movement, John, that might be the time to consider closing this position and rolling out to that further bear put debit spread out to July, maybe, to repair any losses you're taking, or potentially do nothing. But if it starts to breach that short put strike price, you're going to want to act pretty soon. Okay, and don't let it get too far away from you in that case. One of those dangers where we know it could suddenly gap up Monday morning or gap down Monday morning, which would be a favor to you. But if it gaps up Monday morning is suddenly now between both strike prices, then that's where you would be. Okay, so evaluate it from new first, see what you think about the stock, then think about the repairs we saw today. Closing and rolling out, that'd be if you're still bearish. Trying the Condor butterfly repair, that'd be if you're neutral. You think it's going to stay within those ranges we saw, about $57 to $52, $56 to $53, for example. And if you think it's going to continue to be bullish, you could close and look for the bull call debit spreads out to July, or we could see and evaluate that pendulum adjustment, keeping the same expiration, so you're not going as far out as July, still 21 days out, but now in a bullish spread with just one adjustment to the position if the numbers work out in your favor. And that's sort of the review of 7 ways to manage a debit spread, in this case, 7 ways to manage a bear put debit spread. Concepts and ideas. There's pros and cons anytime you make an adjustment. Of course, roll a credit spread, debit spread, even a covered call or a naked put position. Just remember, before you make the roll, don't roll for the sake of rolling. Don't adjust for the sake of adjusting. In that case, reevaluate the stock and see what you would think you would open on the stock today. And of course, there's a question. John, a comment, good comment. He said, so if I don't have an opinion of a stock's direction, it's really difficult to put on any spread position. Is that true? Yeah. And I know we like to use credit spreads that are out of the money, but that's why I use those technicals in the bull put to help me see is these are the trends that we like to see with these positions, because more often than not, they can continue that trend, John. They continue to be bullish stocks in that situation or bearish stocks in that situation. But some were wrong. And you saw that when we did the review of the bull puts earlier on. It was a average. We saw an 89% success rate for what we were looking at, but most of the time it's around 85, 86% success rate with those tests and with the trading on them. So 14, 15% of the time, even though the stock had the criteria we wanted and we were out of the money, we had the probability we wanted, something bad happens. Something just happens. And you've got to manage that effectively. I'm not saying it's a bad idea to put on a spread position if you're not sure of the stock's direction, but maybe you want to consider next time going further out of the money, higher probability, so that when this happens, you're not caught off guard. But yes, I prefer to have, especially for bullish spreads, bearish spreads, really, I don't do butterflies myself, new, because I've never found a stock that's truly, truly neutral or stays within a 1% trading range over a 15 or 20-day period. And I haven't traded an iron condor, which you saw is also a neutral position, John. It's just that table profit and loss instead of the point profit and loss of the butterfly. I don't think I've traded it or rolled to an iron condor since about 2015. I think mid 2015, early 2016, because the market situation didn't seem right to me to do that. It looked like we were managing the upper side too much as the market started to go lower left to upper right, and then there was a lot of volatility where you're potentially losing on the call side, and the next time you see a downturn, you're losing on the put side. So I just stayed with one strategy and then would manage it with the market conditions going forward. So without even knowing your stock, it's you really want to feel that you have some confidence. Just having a low delta, but this is something I firmly believe, just having a low delta of say 0.20 in your short put strike price for your bear put debit, or my short put and my bull put credit, having a probability of 80, 85, or 90% on my bull put credit spread is not enough. I can't just take any stock and say, oh, as long as I have an 80% probability or an 85% probability, I'm fine. I'm only opening a bull put credit if it has the technicals and fundamentals. I'd look for positive MACD, stock above a 50-day moving average. I'm only opening a bear put debit or a bear call credit if the stock's below its 20-day or 50-day moving average and has a negative MACD crossover and is a negative MACD as well, and maybe a negative Bollinger Band breakout also. Those two things in combination, better success rate. You just can't pick 100 stocks and say open 100 bull put credit spreads where we have an 85% probability 2 weeks out we're going to be successful. That's not always the case, right? You want as much to work in your favor as possible. And again, that's sort of why the default screens on power options can help you, because in all those strategies, we put together what we think are the criteria that are best suited for the strategy stock-wise, option-wise, to be successful on a regular basis. And even in the debit spreads or the bear call credit spreads, looking for stocks in a downtrend, avoiding earnings between now and expiration, no surprises one direction or the other. And also, of course, looking for stocks in a downtrend, declining MACD in that case as well, and the probability that you want also. Oh, sorry, there it goes. There it goes. Yes, the stock's down in a downtrend, still the probabilities we want as well, avoiding earnings between now and expiration. Very similar process, bullish or bearish in that case. Combination of both stock, technical, fundamental, and the options criteria to give you the tools to try to be as successful as possible in your preferred strategy. And of course, if you have any questions about the settings on the search, you can always schedule a coaching session. Trial members and subscribers can do that.